Okay, so next the authors double sorted the portfolio factors and formed 5 by 5 portfolios to see what are the returns like at different levels of the factors and different quintiles. So for instance, we see here that each of these little tables here has the size factor, which is the market value of equity, split into quintiles. And then at each of the different tables is a different remaining factor. For instance, the value factors, profitability factor, investment factor, and these are split into quintiles as well. So, for instance, you can see here that the low book to price ratio, well, the companies with the lowest books to price are combined with a portfolio of the companies with the lowest market value of equity. So you could say this portfolio right here would be small growth stocks, whereas this portfolio here would be large cap value stocks. Now, as we've seen before and in prior research, smaller companies tend to outperform larger companies, and value companies tend to outperform growth companies. However, we want to see here how prominent is the value effect after we've controlled for size, and same thing for profitability, investment, and momentum. And to do that, we have here a monotonic relationship. So monotonic would mean that the returns increase at each increase and the level of the variable. Like you can see here that this one's bigger than this one, this one's bigger than this one, this one's bigger, so on and so forth. And so this p-value here would say what's the statistically is each increase in that level likely to be an increase in the return. P-values are set up to be, we want them to be as low as possible, and the number here would be the level of significance. So the authors rate any of the p-values below 0.05 as being significant, and we could say that it's very likely that the relationship here is monotonic. And so in that regard, we would say that the only time that the value factor is prominent or that monotonically increases is with the very smallest of companies. So only in that case does the value companies statistically outperform the growth companies as they get more and more prominent in the book to price ratio. This p-value is 0.06, so it's not as significant as the 0.008, but we could say it's somewhat likely to be a monotonic relationship. Although we see here there's a difference where the higher book to price ratio companies actually have less of a return than the fourth highest quintile. So then overall, across all the sizes, we see the p-value is about 0.11, which isn't in our level of significance that we would like. So we could say that maybe the value factor is not monotonically effective across all the sizes. And next we have the high minus low here, which would be the value companies minus the growth companies. And so in all cases we see that the value companies return more than the growth companies, no matter the size. But certainly it looks like the smaller companies, that value effect is more prominent because this number is higher. But for the larger companies, this relationship is not monotonic where it increases at each increase in the quintile. So next, looking at the profitability, we're using the return on assets here with prior studies showing that higher return on assets typically come with higher returns than lower returns on assets. And we see that somewhat the case in some size categories, but the p-value here is just so high that we would have to reject that this is a monotonic relationship, but also the high ROA minus the low RAA here is really inconclusive across different sizes as well. But like we find before and like other prior research finds, the lowest or the very smallest of companies are the ones that are most prominent in the different factors. So going down to the investment case, prior research shows that companies whose assets increase the fastest, which they term as investment, usually return the least. And so we see that relationship here in most cases where, especially if we look at the high minus low, the ones who invest the most in assets have the least amount of return compared to the ones that invest the least in all size categories. And just like we found in the value section up here, the p-value is the lowest for the smallest size companies. So we could say this investment factor is more monotonically prominent in the smaller sized companies. And actually overall from the joint MRP value, this is below the 0.05 level of significance. So we could say overall that it's likely that investment factor has a monotonic relationship. So next we have the momentum effect. And prior studies have shown that past winners tend to outperform past losers. And we see that to be the case across all size categories, where the highest momentum stocks outperform the lowest momentum stocks. And we also see here that the MRP values are significant for the smallest companies and also the largest cap companies, which is interesting. You usually don't find that in the literature, and is in contrast to a lot of studies. But so we could say the momentum effect is strongest in the smallest of companies and has a monotonic relationship, whereas it increases as the past 6 months returns.